For signs you're financially ready to buy a home. Buying a home is one of the most significant financial decisions you'll ever make, representing not just a place to live but a cornerstone of wealth building and personal stability. In today's dynamic housing market, being financially prepared is crucial to securing a home without compromising your financial future. Whether you're a young professional, a growing family, or an investor, understanding your readiness ensures you step into homeownership with confidence and clarity. But how do you know if you're truly prepared to take on a mortgage and the responsibilities of owning a home? In this article, we're exploring 4 signs that you're financially ready to buy a home, grounded in insights from financial experts like Dave Ramsey and data from institutions like the National Association of Realtors, NAR. These signs are clear, evidence-based indicators that your financial foundation is solid. By the end, you'll recognize these markers in your own situation, understand their importance, and feel empowered to make a smart home buying decision. Stay with us, because you might be closer to owning your dream home than you think, and these insights could guide you to a secure and rewarding purchase. Let's dive in. Sign 1. Your debt-to-income ratio is below 36%. One of the clearest signs you're financially ready to buy a home is having a debt-to-income (DTI) ratio below 36%. Your DTI measures your monthly debt payments, e.g., student loans, car loans, credit cards, against your gross monthly income, showing lenders your ability to manage a mortgage alongside existing obligations. Imagine 2 prospective buyers, Mia and Ethan, both 30 years old, earning $5,000 monthly. Mia's monthly debts total $1,200, 24% DTI, leaving room for a mortgage payment. She qualifies for a $300,000 loan with ease. Ethan's debts at $2,000, 40% DTI, strain his budget, leading lenders to offer smaller loans or higher rates. He doesn't realize his high DTI signals risk, while Mia's low ratio is a sign of readiness. Dave Ramsey, in the Total Money Makeover, advises keeping DTI below 36% to ensure mortgage payments don't overwhelm your finances. A 2022 NAR study found that buyers with DTIs below 36% are 25% more likely to secure favorable loan terms and avoid default. Higher DTIs, conversely, increase financial stress and rejection risks. The good news? You can calculate your DTI today. Add up monthly debt payments, e.g., $500 car loan, $300 student loan, and divide by gross monthly income, e.g., $5,000. If above 36%, pay down high-interest debts, starting with credit cards, or boost income through side gigs. Use tools like Bankrate's DTI calculator for precision. Reflect now, is your DTI below 36% or higher? Lowering one debt payment today could strengthen your home buying position tomorrow. Sign 2. You have at least 20% for a down payment. If you've saved at least 20% of a home's purchase price for a down payment, you're showing a powerful sign of financial readiness. A 20% down payment reduces your loan amount, avoids private mortgage insurance, PMI, and demonstrates to lenders that you're disciplined and committed. Consider 2 couples, Ava and Noah, both 35 years old, eyeing a $400,000 home. Ava saved $80,000, 20%, securing a $320,000 mortgage without PMI, saving $150 monthly. Noah, with only $20,000, 5%, faces PMI costs and a larger $380,000 loan, straining his budget. He doesn't see that his low down payment limits affordability, while Ava's savings signal preparedness. A 2021 Journal of Housing Economics study found that buyers with 20% down payments are 20% less likely to face foreclosure, as lower loans ease payment burdens. The Mortgage Bankers Association notes that 20% down payments often unlock better interest rates, saving thousands over a loan's life. Smaller down payments, conversely, increase costs and risks. The good news is that you can boost your down payment savings today. Estimate your target home price, e.g., $350,000, and aim for 20%, $70,000. Open a high-yield savings account and automate $500 monthly transfers, cutting discretionary spending like dining out. Check local first-time buyer programs for grants. Reflect now. Do you have 20% saved, or are you short? Saving one extra $100 today could accelerate your home buying journey tomorrow. If you're finding this article valuable, please comment number 2 below to let me know you're here. If you haven't subscribed yet, I recommend subscribing and turning on notifications so you don't miss more financial insights. Let's keep going. Sign 3. Your credit score is above 700. Another strong sign you're financially ready to buy a home is having a credit score above 700. A high credit score signals to lenders that you're a low-risk borrower, unlocking lower interest rates and better loan terms, which can save you tens of thousands over a mortgage's life. Picture two professionals, Sophia and Lucas, both 28 years old, applying for a $300,000 mortgage. Sophia's 740 credit score secures a 4% interest rate, with monthly payments of $1,430. Lucas's 650 score gets a 5% rate, costing $1,610 monthly, $160 more annually. He doesn't realize his lower score is costly, while Sophia's strong credit is a home buying advantage. The Federal Reserve's 2022 Consumer Credit Report found that borrowers with scores above 700 save an average of 1% on mortgage rates compared to those below 680, equating to $30,000 saved on a 30-year loan. FICO data shows that scores above 700 reflect timely payments and low credit utilization, traits lenders reward. Lower scores, conversely, raise costs and limit options. The good news? You can check and improve your credit today. Pull your free credit report from annualcreditreport.com and verify your score via Experian or Equifax. If below 700, pay down credit card balances to under 30% of limits and avoid new debt. Set up autopay for bills to ensure timely payments. Reflect now, is your score above 700 or needs work? Improving one credit factor today could enhance your mortgage terms tomorrow. Sign 4. You have a stable income source. If you have a stable income source, consistent earnings from a job, business, or other reliable streams, you're demonstrating a vital sign of financial readiness for homeownership. Stability reassures lenders you can handle mortgage payments, even during economic shifts. Imagine two freelancers, Chloe and Oliver, both 40 years old, seeking a $250,000 mortgage. Chloe has 2 years of steady $6,000 monthly income from long-term clients, easily qualifying for a loan. Oliver's income fluctuates between $2,000 and $8,000 monthly, with gaps, making lenders hesitant. He doesn't see that his inconsistent income is a barrier, while Chloe's stability is a strength. A 2023 Mortgage Bankers Association study found that buyers with 2 or more years of stable income are 30% more likely to secure mortgages with favorable terms, as lenders prioritize predictability. Dave Ramsey emphasizes that stable income supports budgeting for homeownership costs beyond the mortgage, like maintenance. Unstable income, conversely, risks missed payments. The good news is that you can assess and strengthen income stability today. Review your income history, W-2s, tax returns, or client contracts, for at least 2 years of consistency. If variable, diversify income streams, e.g., add a part-time gig, or save a larger emergency fund, 6 to 12 months expenses. Document all income for lenders. Reflect now, is your income stable or erratic? Securing one consistent income source today could solidify your home buying readiness tomorrow. If you found this article motivating, please comment number 4 below to let me know you're here, and consider subscribing for more tips on financial success. Your support keeps us going. Conclusion. Now that you know these 4 signs, your debt-to-income ratio is below 36%, you have at least 20% for a down payment, your credit score is above 700, and you have a stable income source, reflect on your own financial readiness for homeownership. Are you seeing these signs in your situation, or are there areas to strengthen? Buying a home isn't just about signing a mortgage, it's about building a secure foundation for your future with discipline and strategy. Every debt you reduce, dollar you save, credit point you boost, and income stream you stabilize is proof you're paving the way to a home that's yours. Don't let the home buying process intimidate you. Start today, calculate your DTI, save an extra $50 for your down payment, check your credit score, or document one income source. Your journey to homeownership is like constructing a house. The stronger the foundation, the more enduring the result. Keep pushing, because your financial readiness can unlock the door to a home and a future filled with possibility. You've got this. Plan smart and own your dream.